Welcome to another explainer. Today, we are diving into a really fascinating corporate mystery, and that is Skyworks Solutions. Right now, this company is flashing some intensely conflicting market signals. On one hand, we're looking at massive lost contracts, but on the other, surprise earnings beats. So today, we're putting on our expert analyst hats. We're going to use the legendary frameworks of Warren Buffett, Peter Lynch, and Benjamin Graham, alongside some discounted cash flow modeling to just completely cut through the noise and figure out the stock's true intrinsic value. To really understand Skyworks, you have to look at it through Warren Buffett's lens of the economic moat. Get this, a staggering 70% of Skyworks' total revenue is entirely tied up in a single customer, and that customer is Apple. Now, Buffett warns against this kind of setup all the time. When you lack diversification, well, you lack pricing power, and ultimately, you lack a protective moat. Your entire financial ecosystem essentially lives and dies by one single customer's product cycle. And recently, that lack of a moat was exposed in a pretty brutal way. Shares of Skyworks completely plummeted, taking a breathtaking 30% hit in pre-market trading. Look, for a company with a market cap floating around the $10 billion mark, a 30% haircut overnight is just a massive tectonic shift in valuation. If we run this through Peter Lynch's framework, a drop this severe really tests whether Skyworks is still a dependable stalwart company or if it's rapidly shifting into a much riskier turnaround play. So here is our roadmap for figuring this out today. We'll cover 1. The Apple revenue shock, 2. The Q1 earnings surprise, 3. Rising inventory red flags, 4. Wall Street's verdict, and 5. Sustainability and the future. Let's get right into it. Starting off with Section 1, the Apple revenue shock. So, according to some great financial analysis from Money Morning, the core issue here really comes down to the upcoming iPhone 17. Apple is heavily leaning into AI right now, which means they are demanding a smaller chip footprint with significantly lower power consumption. Now, Skyworks actually delivered on those demands, but Apple decided to dual source the chips on the radio frequency socket, rather than relying on Skyworks as their sole provider. This pivot results in an anticipated 20% to 25% reduction in Skyworks chip placement. When we're building a discounted cash flow or DCF model, a structural change like this is a huge deal and immediately impairs those forecasted free cash flows and pretty much breaks your long-term growth assumptions. Management actually noted that the financial hit from this is going to start showing up in the fourth quarter of 2025, and it's going to persist throughout all of 2026. So this isn't just a temporary blip, right? It's a structural loss of market share. And the kicker? It's not the first time it's happened. Just last year, Skyworks lost socket space on the iPhone to their major rival, Qualcomm. Analysts are framing this as an incredibly tough battle going forward, with management themselves admitting that winning that specific lost slot back is practically unlikely or maybe even impossible. It perfectly illustrates exactly why Warren Buffett avoids companies that are tied to these ruthlessly competitive component markets. Moving on to Section 2, the Q1 earnings surprise. Now, if you only read the headlines we just talked about, you'd probably think their financials were in a complete tailspin. But if we pull out Benjamin Graham's defensive checklist, specifically looking for earnings stability, the internal operations are telling a surprisingly different story. For Q1 of calendar year 2026, Wall Street estimated revenue of around $902 million and earnings per share of $1.04. But Skyworks actually delivered $943.7 million in revenue and a non-GAAP profit of $1.15 per share. That is a really solid 4.6% beat on the top line and a massive 10.1% beat on the bottom line. Graham absolutely loves earning stability, and this proves they still have some very serious cash generation capabilities. And the crazy thing is, they didn't just beat Q1. Their forward-looking Q2 guidance totally shocked analysts as well. Wall Street was bracing for a slump, estimating just $861 million in revenue and 93 cents per share. Instead, Skyworks management came out and guided for $925 million in revenue and $1.03 in earnings per share at the midpoint. This is a remarkable flex. Despite knowing those Apple headwinds are coming late next year, they are operating with higher efficiency and driving way more profit right now than anyone expected. Which brings us to Section 3, rising inventory red flags. To find the whole truth here, we really have to look past those top-line earnings beats. We need to talk about the massive spike in inventory levels. Over just one single quarter, Skyworks' days inventory outstanding jumped from 115 days up to 144 days. To put that into perspective, that 144-day figure puts them a full 13 days above their 5-year average. Put simply, They have a whole lot of product just sitting on the shelves. So why is this absolutely crucial to understand? Well, in the semiconductor industry, days inventory outstanding, or DIO, reflects a company's capital intensity. A steadily increasing DIO is a glaring warning sign of weak demand. Peter Lynch would immediately flag this when assessing balance sheet strength, because rising inventory negatively impacts working capital. Remember, this is a cyclical industry governed by Moore's law. Rapid innovation makes yesterday's hit product obsolete today, so unsold inventory eventually forces a company to aggressively slash prices or, worse, downsize production. And we can actually see this tension playing out in their broader efficiency metrics. On the one hand, their asset turnover ratio, which basically measures how effectively a company uses its assets to generate sales, slightly improved from 0.50 to 0.52 in fiscal year 2025. That tells us management is really trying to squeeze every drop out of what they have. But you have to juxtapose that against the grim reality of their long-term sales. Over a 5-year horizon, their sales actually fell at a 1.6% annual rate. So even before the whole iPhone dual sourcing announcement dropped, Skyworks was already wrestling with a prolonged period of suppressed demand. Let's look at Section 4, Wall Street's verdict. Okay, so we have a long-term revenue shock that's counterbalanced by surprisingly strong short-term earnings beats. This dynamic perfectly illustrates exactly how divided and, frankly, uncertain the financial community is right now. Out of 23 Wall Street analysts covering the stock over the last year, a massive majority, 15 of them, have a hold rating on Skyworks. Only 4 are saying buy, 3 are saying sell, and just one bold analyst out there has a strong buy on it. The overwhelming consensus is to sit firmly on the fence. Analysts are just waiting to see if Skyworks can replace that lost Apple volume before they make a definitive move. When we aggregate all their price targets, the current consensus 12-month target sits at exactly $77.06. But while Wall Street might target $77, a true Benjamin Graham intrinsic value calculation or a DCF model running a sensitivity analysis on terminal growth requires us to demand a margin of safety before we even think about investing. When you compare that $77 target to the current, pretty battered share price of roughly $59.76, it reveals that analysts still see an almost 29% potential upside baked into the future. In classic value investing terms, this drop might have actually created the perfect margin of safety that Benjamin Graham always preaches about. Think about it. If the broader market simply overreacted to the Apple news, this current price represents a severe discount to the company's intrinsic cash flow value. That leaves plenty of room for a really strong rebound, assuming the company executes well. Finally, Section 5, Sustainability and the Future. To understand their long-term operations beyond just pure sales, we need to evaluate management quality, which is a key tenet of Warren Buffett's framework. According to their 2025 sustainability report, management is executing their environmental goals incredibly aggressively. They set a goal to reduce Scope 1 and 2 factory emissions by 85% by 2030, and they've already achieved a 64% reduction. On top of that, 87% of their factory electricity is now covered by renewable credits, and they've managed a 12% decline in factory water withdrawal. Now, sure, this doesn't sell smartphone chips directly, but what it does do is prove that management has a very tight, highly controlled grip on their massive manufacturing footprint and their operational costs. So what is our final verdict here? Well, Buffett would likely hate the massive Apple concentration, but Graham, he might absolutely love the deeply discounted margin of safety. If Skyworks can successfully pivot their high-performance AI chips to Android hardware, or maybe automotive and industrial applications, a DCF model suggests some really massive upside. But if they can't, it's a classic value trap. Based on these profoundly mixed signals, Peter Lynch would likely categorize the stock as a solid hold until we see some concrete proof of diversification. Ultimately, the entire future of this stock hinges on one very provocative question. Can Skyworks successfully diversify away from Apple? It is a high-stakes corporate drama for sure. Thanks so much for joining me on this explainer, and keep learning.